Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Tim Crockford of the Hermes Impact Opportunities Fund and Richard Hunter of Interactive Investor. Impact investing is something that many of you will have started to hear quite a bit more about recently, but it's one of those things that to the everyday investor is probably still a little bit of a mystery. So fortunately, we have Tim here, who's going to help explain it because he runs an impact investing fund. So first of all, just the concept of impact investing, what does it mean? And perhaps more importantly, what does it mean to you as the manager of the fund?
Yeah, so I think impact investing is really sort of the third iteration, if you like, of a sort of a range of sustainable investing products that we've seen come about over the last 5 decades or so. And it really all kicked off with sort of social responsible investing, SRI, if you like, where initially what you do was screen out entire sectors, the sinful sectors, if you like, and avoid those completely from an investment point of view. The second wave of sustainable investing really came about through, more recently, through a focus on ESG, or environmental, social and governance. And that really focused not so much on excluding sectors, but more towards making sure that you chose the best-in-class companies within those three areas when you're looking particularly at the operations of those companies rather than the products and services that those companies sold. More recently, impact investing sort of brings it back to focus on the products and services, but what it does, it focuses the lens on a more sort of positive point of view, if you like, where it's looking specifically for companies that are solving the environmental and social problems that we face, if you like, the unmet needs of society, particularly as defined by the UN Sustainable Development Goals.
And presumably, these are areas where not only is something positive being done, but they're growth areas. They're the areas that the world has identified as somewhere where things need to be done, whether it's ranging from bringing down the emissions from the cars that everybody's driving to making sure that people have enough water. One of the things I think that for many personal investors will have thought of over the years around sort of sustainable investing, ethical investing, they'll think, well, the thing is I'm giving up returns, aren't I? Yes. It all sounds very nice, but maybe I'll make my money and I'll do my good things in another place. But this is an opportunity to put the two together, is it?
Absolutely, and I think you said it yourself. That's where the opportunity comes from. It's from, almost by definition, the unmet need creates that marketplace, creates that demand opportunity for these companies who are early to the game in terms of addressing these new industries, because they are all very nascent areas. We're not looking at the sort of traditional sector/geographic matrix of the investment world has historically used for finding investments. This is much more focused on identifying areas through thematic investing and then drilling down into the value chains of these emerging sort of markets, if you like, in terms of emerging business lines that are, as you say, solving these problems, and that in itself is a growth opportunity.
Is there any danger, or do you have a way of screening out the fact that presumably as being unmet needs, I assume a lot of these companies are going to be highly tech focused, and obviously we've seen over the last couple of decades that only a handful of those sort of companies actually make it through and out of the other side. So what sort of things are you looking for in terms of the sort of companies that you're investing in?
Yeah, that's a good question. I guess there's no negative screening at all, but of course the way the fund is run is such that we have 8 distinct investment themes which pertain to these unmet needs, and that in itself ensures that there is a nice amount of diversification within the fund from a more traditional portfolio management sense. But I think you're right in terms of there will be you will find a lot of tech-focused, innovation-driven companies in the portfolio, but you will also find companies which are more traditional in their business models, and we prefer to use the term additionality, in fact, to describe how these companies bring something different to the table. Because essentially, so if you take, for example, a microfinance company in Indonesia that we're invested in, the business model itself is no different to that of a standard bank. But rather than take money, from depositors and lend that out to, consumers for financing house purchases, etc., what they're doing is channeling that money to very small businesses who previously haven't had access to capital funding. So again, no innovation in terms of what they're doing, but the additionality comes from them being in a marketplace that actually no one else is there to serve. And that, again, in itself brings us back to the fact that these are growth opportunities, and hopefully one day these small businesses that they are funding will actually expand into larger businesses and create long-term banking relationships.
And you mentioned these eight major themes? Yeah.
Yes.
Could you tell us a little bit more about some of them and why you think those are essentially growth areas and making a positive change as well?
Sure. So I guess the way we got to those 8 themes really started off with, again, with the UN Sustainable Development Goals, of which there are 17 in total. And all of those goals, if you break them down, they've all got underlying targets which are much more much more focused in terms of being explicit of what they're trying to achieve. So it's things like, for example, better infrastructure, access to healthcare, etc. What we did was take those 169 targets, figure out which ones are actually addressable through the products and services of publicly listed equity companies, and then we refocused those 25% of those targets that were addressable into these 8 themes. So we're looking at things like, for example, future drivetrain, for future mobility in the car space. We're looking at energy transition, so the move towards, for example, renewable energy as a source of power generation. We're looking at health and well-being, which might suggest to a few that we're overweight pharma, but actually, if you dig down into the individual names, it's much more novel things. It's things like genetic sequencing companies. It's things like companies that are helping fund early stage development in biotech, for example. So it's a fairly eclectic mix of companies across these 8 themes, which gives you that sort of sense of traditional portfolio diversification, but obviously all of those themes are focused in very nascent, high growth emerging areas.
And I mean, I suppose to bring it sort of closer to home. At the moment, we have the scenario where the government wants to stop the sale of, solely petrol and diesel cars in the UK by 2040. Wants everyone to shift towards electric cars, are presumed to be the answer, unless another answer comes along between now and then, which seems unlikely. But a lot of the reliance in that model that it's put forwards is going to fall to the marketplace, to private companies to deliver that, because the government hasn't necessarily said, right, well, we're going to put our hand in our pocket and we're going to put in place the infrastructure needed for widespread electric car use. It's sort of gone, well, look, here's the problem, solve it for us. Do you think it's true that that's sort of the situation around the world for a lot of these problems, and because companies are being expected to step in, that's where there's a big opportunity for investors as well?
Absolutely right. I couldn't agree more with that statement. I think governments are great at getting desirable outcomes kick-started, but at the end of the day, we've used the term sustainable a lot. When we talk about sustainability, it's not just about what is environmentally or socially sustainable, but it has to be financially sustainable as well for it to be self-fulfilling and for it to actually have an enduring effect and for the desired outcome it's trying to achieve. So I think the marketplace then has to step in, and that's what we're trying to do. This is why we've taken, for example, the UN Sustainable Development Goals, which initially were actually, they're not meant for investors or companies, they were meant for governments. And that's why we refocused those into investment themes to kind of devise what we think is really the next step towards achieving these outcomes in spaces like you mentioned, like electric vehicles. And whether we actually end up living in a world where we're 100% electric vehicles, who knows? But I think it's fairly safe to say that in 10 years' time there will be a lot more electric vehicles driven on the roads than there are today. And we're looking for the companies that are going to be benefiting from that trend, while at the same time helping solve these problems.
In terms of some of the companies that you might be looking at, are there any sort of blue chips within your list which perhaps, I don't know, have a division which are dealing with one of the themes that you're aiming for? or are we talking about a lot of pretty specific and smaller Malaysian microfinance type companies?
The majority, the vast majority, so if you look across the names in the portfolio right now, of which there are 29, the vast majority of those names will fall somewhere in the middle. So typically in the mid-cap space. And that's fairly intuitive as to why. You know, if you look at these companies, they're not at that sort of early stage, sort of very speculative level. They're sort of received proof of concept. But at the same time, because the markets they're selling into are very early stage, you know, they're still not yet, as you say, blue chip companies. We hope they will be the blue chips of tomorrow. We do expect that, you know, the ones we do get right, hopefully, will go on to be significantly larger companies over the next 5 to 10 years. But I think if you look at generally the sort of exposure you have in terms of market cap size, it's very much rooted within the mid-cap space. And of course, there are some exceptions, both at the very small end and at the very large end. But typically, with the very large companies in the portfolio, they are fairly focused in terms of their product line rather than multinational conglomerates.
And working from the bit where you've like, right, these are the themes, these are the things we've identified, how do you go out and then find the companies that fit into that? What's the sort of process where you go, right, we need to find some of these companies? And then also, is there a particular characteristic of them that means you will or won't think of them? For example, do they need to be profitable? Do they need to not carry too much debt? Or are you not too worried about that as long as they've got that future opportunity?
Well, so starting from where we get the ideas from, as you might imagine, this is not a strategy which lends itself very well to traditional screening approaches, because firstly, screening tends to be very backwards looking, very cross-sectional, rather than looking into what the company is going to be 5, 10 years down the road. But more importantly, perhaps, this is not something which is a data-driven approach. It's not a quantitative approach. It's much more focused on identifying these unmet needs and identifying which companies across the value chain are helping to solve these problems. And that's really what we're trying to do. The themes that we use very much serve as the diving board, if you like, to where we start our idea generation. So we want to become experts within those 8 themes, really understand which sub-areas, of those themes are helping address these problems, and then really dig down from there to understand the individual value chains. Like, for example, electric vehicles. So we look at, for example, the electric vehicle value chain and look at everyone from material suppliers into electric vehicle batteries, all the way down to the OEMs, the car manufacturers that are making and selling these vehicles, and identify first which are the most attractive parts of that value chain, and then try and figure out who are the relative, or who are going to be the relative winners and losers within those more attractive parts. So typically, for example, within the EV value chain, the electric vehicle value chain, we're currently very much exposed to the upstream level. So, for example, manufacturers of cathode materials that go into the batteries, or manufacturers of parts to make electric vehicles, for the sole reason that we don't really know whether 10, 15 years down the road, Tesla will be as big as it is today or as important as it is today. We don't know whether it might be other OEMs or more traditional OEMs that take the mantle. So it's very much about, you know, trying to figure out who are the more safe bets within those very nascent areas.
And then in terms of does it matter if they're making a profit from it now, or is it a future opportunity thing? Where do you fit on that sort of scale?
So we tend to, you know, going back to sort of the chat we had about, you know, where in the sort of caps structure we are, or in the cap scale we are, typically it's going to be companies that already have organic cash flow generation, because, as I said, they've sort of proved concept. As you alluded to as well, we would have sometimes companies who are selling into other industries and transitioning away from those other industries towards these new industries. So the majority of the companies that we're invested in do have a nice organic cash flow generation already ongoing, and most of their growth is self-funded. It's not highly speculative, sort of tiny caps or micro caps that are, you know, that are in need of, firstly, a lot of investor funding, and therefore in need of proving the concept. But I think the more important sort of rule-based structure or framework that we have for companies to be to be part of our investment universe is to firstly, rather, before we've even looked at the financials, to prove that these companies are impactful companies and not just selling, a small product on the sidelines, which is generating some positive impact revenue, if you like, but actually they are mission-driven companies who, if not, delivering most of their revenue from these positive impact sources, or intending to do so or transitioning towards doing that in the future. And that's really the most important thing that decides whether or not a company would fall into our investment universe.
And within that, do you find yourself drawn or investing in any particular geographies, or is the world an open book and it could literally be anywhere?
The world's an open book, and we don't explicitly target any sort of, again, traditional portfolio makeup. The portfolio split is very much the residual of where we find these exciting ideas. But what is interesting, if you look across the holdings, what you typically will find is that there's a bias towards developed markets in terms of where the companies are listed, but there's actually a bias towards emerging market revenues in terms of where the actual revenues are being earned. So that's fairly intuitive in terms of what we're trying to achieve here.
Well, that's all we've got time for, I'm afraid. Thank you very much. That was fascinating, and I'm pretty sure that it's probably a fairly interesting thing to be involved in
Absolutely,
as well.
absolutely.
Tim, thank you very much. Richard, thank you very much. Thank you very much for watching. Join us next time on The Investing Show. Goodbye.